Australian property market is entering a new phase, but not for the reasons most people think. This time, it's not just about the interest rates. It's not just about the supply shortages or rising migrations. A major structural shift is happening quietly behind the scenes. Australia's big four banks, Commonwealth Bank, Westpac, ANZ, NAB, are making moves to bypass mortgage brokers at the very same time that the property prices are accelerating at the fastest pace in nearly 4 years. In today's breakdown, we are going to examine how these forces collide and what does that mean for buyers, investors, and futures of Australian housing market. Now, to understand the significance of this shift, we need to look at the timing. The property market is accelerating again. The prices are lifting across major capital cities, listings are rising sharply, and investor activity is strengthening. But there is something unusual happening beneath the surface. According to the recent report, the big four banks are expanding their proprietary channel, meaning they want customers to come directly to them rather than going through the broker network. Why? Because the margins are being squeezed. Despite higher interest rates, the bank's profitability isn't expanding the way that many assume. Now we all know that the banks have made billions of dollars in net profit, but the core measure of the bank's profitability has actually barely moved. The cost pressures, the regulatory requirements, the intense competition from small lenders have eroded the returns. The banks have discovered that loans written by their own staff are actually 20 to 30% more profitable from the brokers. And with almost 80% of the market currently controlled by brokers, shifting a small portion of that flow back in-house represents billions of dollars in improved margins. This tells us one thing. Banks are preparing for a tougher lending environment. They are becoming more protective of their bottom line and they are ready for the fight. Now, everyday Australians, this shift may not immediately be obvious, but impacts are significant. Mortgage brokers exist to help borrowers compare lenders, secure discounts, and navigate complex approvals. If banks starts pushing borrowers directly to their own channels, they may face higher interest rates compared to broker negotiated discounts, less support for complicated loan structures, and more power concentrated in the big four banks alone. The first-home buyers, this is very relevant. Because they rely on serviceability, workarounds, policy flexibility, and broker-guided pathways to approvals, borrowers with non-standard income, self-employed, contract workers, multi-income families could also be affected. They often rely on brokers who know which lenders will accept their financial profiles. As banks shifts their strategy, the home loan landscape becomes less competitive and more bank control than it has been in decades. Now, at the same time, the housing market is heating up. The prices are rising fast. In nearly 4 years, this is the fastest. Australia's residential property market is now approaching 12 trillion in total value, a staggering number that reflects both scarcity and demand. The spring's listings have surged. Sydney is up by 20, Melbourne is up by 30%, national listing is up by almost 22%. Despite more sellers finally coming out to market, demand remains fairly stronger than the supply. This is why auctions are competitive again. It is why properties are selling above the pricing guides, and it is why days on markets are shortening. Meanwhile, you can see that the rental market remains under extreme pressure. The vacancy rates are hovering between 0.4% to 1.3% depending on the city and well below healthy levels. Let's look at building approvals, 26% to 40% below long-term average. Put simply, Australia is not building fast enough to meet the current or the future demand. The buyers entering the market today are stepping into one of the tightest supply environments Australia has ever experienced. So, why property are rising despite higher interest rates? There are several reasons interconnected here. The first, that the investor lending has surged in some states like New South Wales. Investor lending is up by almost 17% year on year. Investors are responding to higher rent rises, tightening supply, and improved yields. Second, the gap between the house and the unit is record high. This has pushed many buyers, especially like first-home buyers, towards affordable housing markets, creating upward pressure in segments that were previously stagnant. And third, of course, the migration continues to outpace new housing supply, and Australia is absorbing more new residents than the new construction industry can actually accommodate. And finally, there is a behavioral shift. Buyers who have been sitting on the sideline waiting for the rate cuts are now entering into the market fearing that they'll be priced out when the rates eventually start to fall. And all these factors combined creates a market where demand is rising sharp, but the supply remains structurally weak. One of the most important questions here is, will interest rate change this trend or this landscape? The Reserve Bank of Australia remains still very cautious. Inflation has been sticky and the labor market is relatively strong with unemployment around 4.3%. While markets anticipate that rate cuts somewhere around the next year, RBA has not committed firmly to this yet. And that uncertainty matters. If The rates remain high for longer, borrowing power stays capped, buyer demand remains controlled, price growth moderates, but does not necessarily reverse. If rates fall in sooner, we may witness a renewed surge in demand, a fresh wave of buyers re-entering into the market, the investor activity ramping up even to the highest level, and the price growth accelerating to the maximum level. So at this stage, RBA is signaling patience, which means that the current conditions, a resilient market with limited supply, is likely to continue. For investors, the current environment is perfect. It prevents both the opportunity and a challenge. Opportunities exist in markets with the rental demand far exceeds supply. We're talking about areas like Hobart, Perth, Adelaide, Brisbane continue to show strong rental yields and consistent tenant demand. Even Sydney and Melbourne, the undersupplied pockets of Southeast, continues to attract investor interest, especially where infrastructure projects are playing a really big part. However, the borrowing capacity still remains quite high, which means that the higher interest rates and stricter servicing assessments have reduced the average investor lending power. Now, with the banks reducing reliance on the brokers, comparing loans may become more difficult. Or to adjust their strategies towards cash flow positive markets, the underlying theme is very clear. Despite constraints, rental markets remain historically tight, supporting long-term investor demand. Now, is this a growth phase or is this a bubble? With property prices climbing again, the inevitable question rises: is Australia in a genuine growth phase, or is this beginning to be another bubble? From a structural standpoint, the evidence points to a genuine supply-driven growth phase. From a price growth, the price growth today is not being fueled by speculative borrowing. It's actually driven by not the easy credit. It's not supported by loose lending standards. It's the primary driver is chronic undersupply, the renewed investor activity, the strong migration, the growth rental pressures, the infrastructure spending that is happening through the limited new construction. And however, this does not mean that the market is like risk-free. If the lending tightens further, either through bank policy changes or macroeconomic indicators, the demand could soften. If the economy weakens or unemployment rises, buyer confidence could stall. But for now, the foundational supply shortages gives the market a strong underlying floor for years to come. This is not just a small short supply that would last for 6 months. This is years and years of underlying floor that needs to hit its ceiling. Australia's property market is shifting, not just in prices, but the mechanics of how the loans are distributed and approved, and the bank's changing strategy. The supply remains constrained. The next 12 months would be pivotal in making wealth in Australia. If you want to continue seeing the updates on Australian housing market with clear data-driven insights, make sure to subscribe to our channel. This is Mox checking out. Till the next time, adios.